Welcome back. You're watching The Money Show on ET Now. Well, it's time for our Meet Your Fund Manager segment. And this time around, we're not going to talk about a fund that's already open and sort of available for you guys to do your SIPs or do lump sum investments in, but one that will be very soon. It's a new fund offering, or an NFO. It's open for subscription. That's the first time that people will be investing in this fund from tomorrow onwards. The fund I'm talking about is the ICICI Prudential Business Cycles Fund, and I have with me the fund manager, or should I say the future fund manager for the fund, Anish Tawakley. He's a senior fund manager and head of research with ICICI Prudential Mutual Fund. So Anish, thank you so much for joining us today on ET Now to talk about the fund. So starting off, introduce the fund, to our viewers, some of whom I'm sure are very interested in knowing about the fund, were interested in, being first-time subscribers. Just, talk to us about the fund, the objective behind launching this fund at this juncture.
So look, as you know, the fund is called the Business Cycles Fund. So what is a business cycle, right? We all know that the economies go through cycles. You have periods of booms and you have slumps. What does a boom look like? A boom is a period where you have very strong growth in demand. Factories are operating at full capacity, 3 shifts operation, perhaps adding capacity. As factories are adding capacity, credit growth is strong. Profitability is high, obviously, when there's strong demand. From an employee's perspective, wages are rising. There are multiple job offers. On the other hand, an economy, when it's in a slump, basically there's not enough demand. Factories are lying idle or operating at less than full capacity. The focus is on cutting costs. Profitability is weak. There's not much investing happening, so credit growth is weak, right? So these cycles of boom, when you have booms and slumps in the economy, obviously the sectors that would be appropriate for investing at different points are different, right? If the economy is booming and there's a lot of investment activity, sectors like corporate banks or capital goods would do very well. When the economy is in a slump, those sectors would go through periods of pain, right? So the idea behind this fund is that we will look at the economic cycles and choose sectors appropriately based on the economic cycle. We will be looking at both what is happening to the economic cycle in India and to the economic cycle overseas, globally, right? So if you have the Indian economy weak and the global economy strong, you might look at more export-oriented sectors like IT or pharma. Whereas if the Indian economy is stronger, the global economy is weak, you would position the fund, position the investment differently, and look at sectors like domestic capital goods, banks, etc. So the idea is that, look, there are economic cycles. Different sectors make sense at different points in the economic cycles, and we'll invest appropriately based on the phase of the business cycle. So what does that mean for the investments? It means that at any point in time, this fund will have significant sector concentrations, right? So a large part of the fund's investments will be in sectors that we think are appropriate at that time, and we will consequently also be avoiding some sectors that we think don't make sense at that time. Now, very often investors, when they invest, they look for sector X fund, sector Y fund. Somebody might say, I'll invest in FMCG, or somebody might say, somebody might recommend banks, etc. What this fund effectively does is says, look, we will invest in sectors that are appropriate at any point in time. So the investor then does not have to worry about, hey, is the banking sector the right sector for me at this point? I had invested 1 year back. Should I take the money out? If we think it makes sense to move out of banking into FMCG, we will do that, right? So that's the idea, right? That this will be a sort of a thematic fund, but the underlying themes will change as the economic conditions change. Right now, why? I think you also asked why it makes sense at this time. See, at the current stage, the economy is at a very interesting point, right? If you look at the year 2020, basically, top-down investing has been very, very appropriate, right? In March, April, if you looked at it bottom up, you would have seen lots of problems in individual companies and in individual sectors. But the reality was that because there was so much monetary and fiscal support, right? Interest rates globally were so low. There was so much fiscal spending, tax relief, that the economy is actually recovered. So that is, if you had taken a top-down view and said, look, with so much monetary and fiscal support, things will recover, you would have been better off. So the point is there is an appropriate time for top-down investing, and we think that will continue for the next 3 or 4 years. Why do we think it will continue for the next 3 or 4 years? look, interest rates are near zero in many parts of the world. Even in India, they are at very low levels. Similarly, government spending and has been high. Fiscal deficits are high. At some point in time, when these things will normalize, and how these things normalize will determine both how economies pick up and how markets react. So a fund that focuses on these factors is kind of appropriate given that there is so much uncertainty about the macroeconomic path.
Okay, so you're essentially taking off the headache, from the retail investor's head in assessing that, okay, now that, we are in recovery mode, what are the sectors that tend to bounce back the fastest? Or, okay, now that, things are looking a little precarious and we are heading towards uncertain times, then where should I exit and where should I fill up my positions? So you're taking that headache away from the retail investors, by launching a fund like this. And it's very interesting indeed. I mean, I don't know, correct me if I'm wrong if I have to say that this is a one-of-a-kind fund. But Anish, from what you tell me, would it be right for an individual to assume that, okay, if they are going to be constantly, not that business cycles are, of course, short, they are long, but they are getting a little short. So what would the turnover essentially be of the portfolio? Where would you like to cap it? Because in a way, when we talk about turnover, we're also looking at costs of the fund, right?
Well, that's a very good question. Look, the idea is that, firstly, business cycles are, they last relatively long, right? So it's not like every day or every month you say, hey, we are in recovery, tomorrow we are in slump. But the length of the business cycle depends on the policy conditions, right? If you are already in a boom, right? The economy is already booming and the policy remains very supportive, or interest rates remain very low, fiscal policy remains very, very lax, then the boom extends and the amplitude of the boom becomes very high, but then you have a very hard landing. Conversely, if you have counter-cyclical policies, which is what you should have, right, that when the economy is strong, you should do austerity and raise rates, but when the economy is weak, you should run large fiscal deficits and keep monetary policy easy, then you get a smoother macroeconomic environment with smaller booms and busts. So, but anyway, these cycles last 3 to 5 years. So the churn will only happen when we see economic conditions changing, right? If we have read the economy right, if we've selected sectors appropriately, we will wait for those things to play out. Hopefully we will be churning after good performance. So I don't expect churn in this portfolio to be too high. I would also point out that look, when you do bottom-up stock picking, after the stock has done well, or when you change your mind, you churn. So in that sense, there's no difference. The churn will be no higher than it would be for another fund, and it would just be driven more by macroeconomic conditions rather than by microeconomic bottom-up conditions, right? So rather than saying, hey, look, this company has come up with this opportunity and this or this threat, we changed the position. It would be more influenced, the overall level of churn will be influenced more by what's happening overall in the economy rather than merely by company-specific conditions. But I don't expect churn to be higher than it is for any of our other funds.
Okay. What should be an investor's time horizon before he or she considers investing or subscribing to, this NFO?
This is an equity fund, right? And we never recommend equity funds for short-term time horizons. We always say that any investor who's investing in an equity fund should have at least a 3-year time horizon. And that applies to this fund as well.
Okay, so have a longer term view. It is at the end of the day an equity fund, and when you invest in equity funds, you should always ensure you have a long term view, at least more than 5 to 7 years preferable. Let's talk about the risk factor of this particular fund. Anish, if I had to, let's say, compare this with ICICI Prudential's large cap fund or ICICI Prudential's mid cap fund or small cap fund, how would you pitch them in terms of the risk factor of all of them?
So let me describe how we are managing, what are the risks, how we are managing the risks, and then compare them with some of the other products, right? So what we have, while we will be taking large deviations from the index in terms of sectors, what we will try to do once we've selected the sectors, we will try to diversify as much as possible at the stock level, right? So stock level risk we will try to minimize by saying, look, let's keep the level of diversification within the sector high. What does that mean in practice? So if we say select a sector like IT and we say company A looks a little bit more attractive than company B, it's not like we'll put all the money in company A and ignore company B, right? Then we'd say, okay, we've already taken very high sector concentration. Let's spread it out between companies A, B, and C to the extent it practically makes sense. So there will be significant deviations from the index, but mostly at the sector level, not so much at the stock level. The second risk, in a fund like this, always comes from the fact that if there's only one individual who's making all the decisions, bias or whatever might creep in, right? Which is why we have a team of 4 involved with the fund, right? And that includes Naren, me, Manish Panthia, who's from our debt team, and Ihab, who's covered multiple sectors in equities. So the idea is, and the most important point I'd highlight is we have a person from both debt in this, from a debt side also involved, because that gives a more robust perspective on what is actually happening to macroeconomic conditions and how they are changing at
Okay, great. Well, folks, just to tell all of our viewers, the NFO opens tomorrow, the 29th of December, and it'll close on the 12th of Jan 2021. So you have roughly about 12 to 13 odd days to subscribe for it. And Anish, thank you so much, for taking out time to introduce this fund, this one-of-a-kind fund, Business Cycles Fund, to all of our viewers. As the name suggests, it focuses on riding business cycles. There are periods of booms, there are periods of busts. There are certain themes that work during a boom, certain that work during a bust. And really, that's where Anish will sort of try to capture opportunity for long-term, being the operative word, wealth creation. And on that note, we'll take a very short break.